As of 11:12 p.m. Eastern Time on October 3, 2025, SoFi Technologies, trading under the ticker SOFI, is currently priced at $25.53, experiencing an intraday dip of about 1.68%. Now, most investors see that price and immediately anchor to the popular narrative, the student loan company that's trying to become a bank. That's the story, that's the expectation. But the reality of what's moving this stock today and what will define its future is far more intricate and lies deep within the company's less discussed operational shifts. While everyone is focused on the front-end app that offers everything from personal loans to SoFi Invest, the real engine humming in the background, the piece that institutional investors are quietly betting on, is its technology platform segment, specifically the synergy between Galileo and Technisys. This isn't just about adding new user accounts, it's about building the foundational plumbing for the entire fintech industry, aiming to be the Amazon Web Services of financial technology. This strategic pivot from being just another consumer-facing app, competing with the likes of Robinhood and other online investing platforms, to a critical B2B infrastructure provider is the fundamental disconnect between the market's general perception and the company's actual long-term trajectory. The common belief surrounding SoFi stock is that its success is inextricably tied to the macroeconomic environment for lending, particularly student loan refinancing, and its ability to keep growing its member base. The headlines love to focus on member growth, deposit growth, and loan origination volume. The expectation is linear. More members lead to more cross-selling, which leads to profitability. This is a simple, appealing story, and to be fair, it's a significant part of the equation. We see the constant marketing pushes for their investment help and self-investing tools, positioning SoFi Invest as a viable alternative for those exploring different investing sites. Yet this view is dangerously incomplete. The reality is that SoFi's fate is becoming increasingly dependent on its ability to execute a complex vertical integration strategy. The acquisition of banking technology platform Technisys and its integration with payments processor Galileo is designed to create an end-to-end, vertically integrated banking technology stack. This allows SoFi to not only power its own products with greater efficiency and speed, but also to sell this powerful infrastructure to other banks, fintechs, and even non-financial brands. The potential cost savings from moving off third-party cores are substantial, estimated to be in the realm of $60 to $70 million annually post-integration, and the revenue synergies could add a cumulative $500 million to $800 million by the end of this year. This is the hidden in plain sight catalyst that the market often overlooks when fixating on the latest CPI print or Federal Reserve commentary. Looking at the recent stock movement, the intraday drop reflects broader market jitters, but it also speaks to the volatility inherent in a stock that is still largely classified as a growth name. Trading volume today is robust, already approaching 29 million shares, indicating active participation from both retail and institutional players. This level of activity is typical for SoFi, which has become a battleground stock. Digging into the institutional holdings provides a clearer picture of the strategic positioning. Recent filings show that while some firms have trimmed their positions, major players like Vanguard and BlackRock maintain very large stakes. More telling is the trading the shorter-term lending cycle. This is a critical distinction for anyone looking at SoFi through a simple lens. It's not just about whether they can originate more loans next quarter. It's about whether they can successfully become the technological backbone for other financial institutions. Find on a Standard Fidelity brokerage overview or a Robinhood stock trading app's newsfeed. It requires a deeper familiar with the company's core operations. SoFi started in 2011 with a focus on refinancing student loans for high-earning graduates. From there, it expanded its offerings aggressively. Today, its business is structured into three main segments: lending, financial services, and the aforementioned technology platform segment. The lending segment remains the primary revenue driver, offering student loans, personal loans, and home loans. The financial services segment is their attempt to create a comprehensive digital finance ecosystem, encompassing SoFi Money, a checking and savings account hybrid, SoFi Invest for active and automated investing, pitting it against services like Schwab Intelligent Portfolios, SoFi Credit Card, and other products. The idea is to create a flywheel effect, attract a member with one product, like a personal loan, and then cross-sell them into other services, increasing their lifetime value. The bank charter, which SoFi obtained in early 2022, was a monumental step. It allowed dramatically lowering its cost of capital and boosting its net interest margin to an enviable level, close to 6%, which is significantly higher than most traditional banks. This has been a key factor in its recent push towards consistent GAAP profitability. The technology platform, anchored by Galileo, provides the API-based infrastructure that powers many other fintech companies' card issuing and payments processing capabilities. The acquisition of Technisys is meant to supercharge this by adding a modern, cloud-native core banking system to the mix. Looking ahead, the future outlook for SoFi is a tale of immense opportunity balanced by significant execution risk. The primary catalyst is the successful integration and scaling of its technology platform. If SoFi can truly become the go-to infrastructure provider for digital banking, the potential market is enormous. This would transform its revenue mix, making it less susceptible to the cyclical nature of lending and more aligned with the secular growth of digital finance. Continued growth in high-quality deposits will also be crucial, as it provides a stable, low-cost funding base that is a powerful competitive advantage. The expansion of its financial services offerings, like the recent introduction of new options trading levels within SoFi Invest, aims to capture a larger share of their members' financial lives, moving beyond simple transactions to more complex investment and wealth management needs, a space traditionally dominated by firms offering services like Fidelity Wealth Management or Interactive Brokers Trading. What do you think is the biggest challenge facing SoFi right now? Is it the macroeconomic pressure on their lending business, or is it the internal challenge of executing their complex technology integration? Comment below with your thoughts. In summary, the narrative of SoFi as just a digital lender is an outdated expectation. The reality is that SoFi is a company in the midst of a profound transformation, attempting to build a durable competitive advantage not just through its consumer-facing brand, but through the deep, underlying technology that powers the next generation of financial services. The tension between the short-term reality of its sensitivity to credit cycles and the long-term expectation of its platform strategy is what defines the investment case today. While platforms like a SoFi active investing account or even an individual brokerage account at Fidelity offer easy access to buy the stock, understanding the deeper strategic shifts is what separates a speculative bet from an informed investment. The intraday price action is just noise. The real signal is in the company's ability to execute its ambitious vision of becoming the essential infrastructure layer for modern finance.